everybody. It's John Llodra here from New Harbor Financial Group for our weekly market and client update. The headline of this video hopefully caught some eyes because today, literally today, October 19th, as I'm recording this, is the 36th anniversary of the crash of 1987. It was the single largest percentage point drop in the stock market history on that day, 36 years ago today. So, of course, wanted to pay homage to this rather significant event in financial market history. After all, we are, in what we do here, very much students of financial markets history. Though we've been doing this for the better part of 20 years or so, we absolutely, in forging our views and takes on markets, go back and study market and economic data for many, many decades. And I was 17 at the time when that happened, so I certainly wasn't too tuned into markets, but it's a time that many folks recall quite well. So the question that we and others might be tempted to ask, could something like 1987 repeat itself? And I guess I wouldn't do it justice if I didn't share a headline from the day, because this is what the headlines on the newspapers looked like in 1987. So you can see here, New York Times, stocks plunged 508 points, which is a drop of 22.6%. Headline here, does 1987 equal 1929? Very, very big day in markets. And the question should be thought of, can the boogeyman come back again, and can an event like that happen again? Let me just show you in a graph of the S&P 500 for 1987. You can see in the first part of the year, we had a massive ramp higher in the stock market, maybe not unlike this year, 2023, up until the end of July anyways. And then you had some weakness here. This is, I think, about 7% or so down week. And then on Tuesday, October 19th, we had this over 20% decline in the market right here. And of course, the market ended down quite a bit. So could this happen again? Well, let me explain a couple of things. So the magnitude of that drop, as significant as it was, I think it's fairly unlikely in any single day we would see a drop of that magnitude. Most notably because there have been put in place circuit breakers and different mechanisms in the modern markets that would basically shut down the markets at different thresholds. So it's pretty unlikely, in our opinion, that a single day drop would look something like that. We certainly would not take off the table a drop of that, or actually quite much larger over time. In fact, as we'll talk about in a bit, from current valuation levels, history suggests quite a large drawdown in the stock market is not only possible but likely. But the catalyst for that event in 1987 were multifold. There are thoughts that it was tied to things like the Plaza Accord and the Louvre Accord, which was monetary and political deal making that was going on at the time. You might say we have a similar kind of interesting backdrop, if I could use that word, from a monetary and geopolitical standpoint now. So certainly there are some rhymes that equate to or are similar to what we saw in 1987. One of the major catalysts in 1987 was what at the time was called portfolio insurance and program trading. So you basically had these computer programs that were programmed to trade off different hedge levels. And there was basically a waterfall event. There was cascading multiple sell orders and things like that basically took over the system, and combined that with massive panic on the part of investors. And you had the recipe for what happened in 1987. Again, I don't think, given the circuit breakers, we'd see the same kind of magnitude. But absolutely, today, more than ever, we've got a massive amount of computer algorithmic trading. We've got very complex markets. I'd argue way more complex than we had in 1987, with dark pools and shadow banking systems and things like that could be very contagious. And then, of course, I'd be remiss if we didn't talk about market valuation. So let me share a chart there, because as you'll see in a moment, the market was actually not that crazily overvalued back in 1987, certainly not by compared to today. So here we go. This is a chart of what's called the Shiller cyclically adjusted PE ratio. And this is one of the more reliable PE ratios insofar as having a predictive value for future returns. You can see right now we're just a little bit over 30 on that metric. 1987 was right here. So right before that big drop in 1987, the metric was about 16. So a little less than half of what it is today. In other words, you might say the market could drop 50% today and still just be at the valuation levels that were in 1987. So from a valuation standpoint, the market is certainly, in our opinion, has much more fuel to fuel a downside sell-off of a similar magnitude, even if not in one day. Can it happen? We think there's a lot of reasons to be very concerned about the markets today. Again, we think it would probably play out over a series of days and months, not one day. But absolutely, our very strong opinion is not only is it possible, it's quite likely we'll see a dramatic pullback in the stock market. So I want to kind of pivot a little bit. One of the things that has been catching everybody's attention, in fact, Jay Powell, the chair of the Federal Reserve, gave a speech today. And basically, interest rate environment and the interest rate rise over the last year and a half or so has largely been in response to spiking inflation. After a decade of essentially 0% interest rates, inflation finally took off, and I don't have to tell folks who are listening or watching here today, you see it in your pocketbooks, you see it in the everyday things that you have to pay for and consume. But that is very much the impetus for much of the interest rate policy spikes in the last year and a half. I got to share a comical post that a noted academic, Paul Krugman, he's a Nobel Prize winning economist, and I'll share a tweet that he put out just in the last week or two, and it caught a lot of people really with a lot of jokes and poking that were aimed at him. This is his tweet. He basically, you might call this a victory lap of the most egregious sorts. His tweet, as you can see, says, "The war on inflation is over. We won at very little cost." And it shows a chart of inflation over the last year plus. And of course, the key here is the chart he shared here is if you take CPI, Consumer Price Index, and remove things, basically remove energy, shelter, food, and used cars, which, of course, these are the things that most people absolutely have to need in their lives to live on. So there was a huge backlash in Twitter. People were posting charts that basically had no line and said, CPI, if you remove everything that everybody needs. And so a lot of flack here. And our personal take is that, and the market is seeming to believe this, that inflation is and will likely be stickier than many have believed. Now, if we get a major economic or market correction there, we think inflation will come right down. But absent that, we think inflation is going to be a persistent problem, so much so that the Fed has come out and basically professed that they're going to remain higher for longer, and meaning keeping their interest rates higher for longer. And of course, that has dramatic impacts on things like the bond market. But it also has impacts on things like, basically mortgage rates. Mortgage rates just today, maybe today, yesterday kind of thing, peaked at 8%. It's basically a level we haven't seen in decades. Basically, that has created a massive increase in the price of housing. I'm going to share a chart here from Redfin, which is a real estate research firm. And it basically shows the effective cost, for what homeowners need to earn in order to afford a median price home. And as of August of this year, and this doesn't even count the recent rise in interest rates to 8%, homeowner would have to, a buyer of a median price U.S. home would have to earn about $115,000. That's up from $52,000 in 2012. So when folks like Krugman say inflation is fine if we remove things like shelter, well, the reality is most people need a place to live, and this has never, at least in this time series, been worse than it is right now. The markets are pretty spooked by that, and rightly so. And it's having pretty dramatic impact on markets. So the bond market has been the most observant of these issues, and when I say observant, that's basically tantamount to saying the bond market has sold off quite dramatically. In fact, the pullback in the bond market has I apologize if I said stock market. The bond market has sold off quite dramatically, whereas the stock market has actually been quite benign. It's been somewhat asleep at the wheel, in our opinion. Actually, quite a bit asleep at the wheel. So this next chart I'll show you shows basically drawdowns in bond markets going back to the 80s. So look at this chart. It was put together by Goldman Sachs and some other research providers. But basically, this is the drawdown in the bond market. It's without parallel in any time in this history here, and that has basically roiled markets pretty dramatically. And we waited until a pretty substantial part of that pullback happened to begin to nibble on longer term bonds. Most of our bond exposure has been very short term treasury bills that are finally yielding over 5%, close to 5.5% right now. So we've been very reluctant to buy longer term bonds, but we did add about a 15% position, and we'll talk about this later. But we waited for much of this bond sell-off to occur before starting to do that. And of course, with the rise in interest rates, bond markets have sold off much further, and we have taken defensive action, and we'll talk about that in a bit. So pretty dramatic moves here. In terms of interest rate policy, the market since September has priced in a lower expectation of Fed starting to pivot and lower rates. In fact, I think the market is now pricing in, maybe not a rate drop, at least the most probable a rate drop until, say, third quarter of next year, 2024. And that's, pushed back from even just a month ago, where there was a belief that first and second quarter might be where we'd see a rate decline by the Fed. But so the rate policy is really critical to the bond markets. But increasingly, things like the fiscal situation is being pointed to as a real structural reason why the bond market has been struggling. And I wanted to kind of share a couple of pictures of that. So let me share a chart here. This is right from the Federal Reserve's website. So this chart goes back to, as you can see, the 60s, and there are two lines here. The first line, the red line, basically shows the percentage of total public debt, total debt issued by our government basically, as a percentage of GDP. Okay, and you can see over time, things have risen and fallen, but really here in the wake of the financial crisis of 2008, 2009. That debt issuance as a percent of GDP rocketed higher like never before. And then again here in a basically a step change in response to COVID. It's trailed off a little bit as Fed has retired some debt off its balance sheet, but with recent spending plans and whatnot, it's very likely that will continue to rise. So that is measured on this left axis. So we are essentially 120% of GDP is where our public debt is right now. Now, the blue line shows the interest payments by our government, our treasury, on that debt as a percentage of GDP. And that's on the right axis. So you can see here, right now, we're approaching 2% of GDP in interest payments. Okay, not the highest point in history. In fact, if you go back to the 80s when interest rates spiked, to double digits on even money markets, the percentage of GDP was higher at about 3%. But key point here is that the total amount of debt as a percent of GDP was far more benign back then. It was about between 60 and 70% at the worst of it. Quite a different story as compared to now, where it's 120% plus of GDP. And the thing here is this debt level, we would contend was not that problematic because economic growth could more than sufficiently justify and pay down that debt. And in fact, if you look at economic growth over the last 40 plus years, in the 70s, for example, it had averaged structural GDP, real GDP, I should say, averaged about 4%, and that's comprised of mostly just basically labor force participation and the productivity rate. In recent years, that structural growth rate has declined to only about 2%. So not only are we seeing less growth to support and pay down debt, but we're seeing essentially almost a doubling of that debt. Really problematic. And that is what has contributed in large part to the bond market's jitters. And this next chart I'll just show you, this is put together by John Hussman, who we admire for his analytical work quite a bit. And this is basically as a way to kind of look at, so I'm going to go back to that prior chart. So here in the 80s, you had high percentage of GDP of interest payments, but relatively low debt. Compared to now, you have somewhat lower percentage GDP in interest payments, but much higher debt. And what this next chart does is it basically expresses, if we imagined the Treasury was a homeowner, if you will, and had to pay this debt back off like a mortgage, this basically shows the combined effect of the debt levels and the interest rate. And effectively, if they had to pay this off as a mortgage, or either over 10 years or 30 years, you can see the effective mortgage payment as a percentage of GDP is off the charts compared to any time in history. So just a wake-up call. The fiscal situation in our country is serious. It's real. It's not imagined, and markets are starting to pay attention to that. So basically, I wanted to kind of quickly bring it back to markets and our client accounts. As dire as the bond market has been, we think it's actually quite ripe for a near-term rally. By no means are we long-term, very, very pound-the-table bullish on bonds, but in the short term here, we think it's quite likely that longer-term bonds will rally and interest rates will moderate somewhat. So I'll share a picture of that. Basically the 10-year yield on 10-year treasuries hit, I think, 4.98 today, which is, might as well call it 5%. We've been saying in recent weeks, we think, certainly go back to some structural models and some history, that the 10-year could get as high as 5, maybe 5.25 in an extreme series. So we're getting very close to where we think the 10-year rate, might peak out if it hasn't already. So we've gotten a little bit more constructive on the longer term bond, and I'll talk about what we've done there. So let me pull up a chart here of an ETF, TLT, which is certainly a one way of looking at the long term. This is a 20+ year Treasury ETF, holds 20+ year Treasury bonds, average maturity of about 20, duration of about 16, 17 years. And this is basically a chart over the last few years from 2020 to now. You can see this is that big record drawdown that we saw in the other chart. We didn't start buying or nibbling at this until around here, generally speaking. So much of the damage had already been done, but yet it's continued to roll over. And what we did is we've trimmed positions in a couple of ways. We either lowered the position size to starting from 15% down to about 7.5%. We've either done that by outright lessening the position or by incorporating hedges, put option hedges that have the effect of selling the stock at a higher price. So we for example, we had a put here at $98 a share that basically for half the position protected declines below there to a large degree. And sure enough, that's what happened. So much of that decline on half the position we have for folks was neutered or offset by gains on the put options here. In that weakness, we took the opportunity to punch those put options down and book a profit, punch them down to $92 a share. Again, keeping robust protection in place, but taking some profits of that hedge off the table. And then just today, on the weakness in the bonds with that spike to close to 4.98%, close to 5%, we punched those puts down to $85 a share. The net effect of that is we've added about, if we had a notional position of about 7.5% exposure there, we've increased that to 10, 11, maybe 12%. Not a dramatic increase, but we do think there is very likely a sharp bounce in store here, and we just wanted to kind of tactically add a little bit more exposure there, having taken much of this risk off the table. Wanted to kind of give a quick update on that. And then one final chart I'd like to pull up is on gold and gold miners. This is a chart of the gold mining stock ETF GDX. And I'm going to go to a shorter term chart for this one. This is a daily chart. basically we had a very sharp sell-off here, from in September to early October, and since then, this is roughly around when the unfortunate war in the Middle East has flared up, and we've had a very sharp rally in gold and gold mining stocks. So that's been very helpful. As clients know, we have roughly about a 10% allocation to that in our client account. So that's been a helpful recent development. And these dotted lines basically are where we have hedges. So we do have a hedge in place at $26 a share. So if we did pull back and revisit this and go below that, those hedges would kick in and start to protect the downside from there. And we paid for those hedges by selling call options at 33. So we have upside, and it's on about half of the position. So we have upside to about 33 and downside protection below 26 for about half the position for those accounts that can handle options given their size. So I wanted to kind of, maybe stop there. This is obviously just one way we want to update folks. We obviously invite client questions, comments anytime. These videos certainly do not take the place of one-to-one conversations that we are very welcome to have with you and enjoy having with you. So, we're keeping our eyes very open, and we're acting nimbly here to adapt to what we think is going to be a fast-moving and dynamic market. On that note, we have seen some strengthening in the energy market, and certainly the crisis in the Middle East has given rise to a spike in oil prices and things like that. So we're actually looking at ways to play the energy market. And one area that we think has lots of near and frankly longer term potential is in the nuclear space. So we're actually very, very strongly considering and maybe likely to add a slice of exposure to the nuclear space. This would include nuclear utilities that are, use nuclear energy in their mix, nuclear fuel companies, nuclear services companies. We think it's going to be a really important slice of the electricity equation going forward, even as we move to renewable sources like wind and solar and things like that. So just wanted to keep you up to date. Again, we appreciate you watching, and we invite any questions you have. And until next week, we hope you have a great day and a great weekend, and thank you for your trust in us. Bye now.